What's up, everybody? Today we are analyzing Eli Lilly and Company, which is a massive pharmaceutical company. It has risen 520% over the past 5 years and now is sitting at a $724 billion market cap with a price to earnings ratio of 137, even with a profit margin of 15%. So their price to sales is quite high at around like 22 or 23. And so seems like an overpriced company. Mainly fueled by speculation about their new weight loss drug that just got FDA approved. Now let's check out some other financials and statistics for this company. Let's take a look at their revenue. So it looks like their revenue went from 22 billion in 2017 to 34 billion in 2023. Looks like it has been flat, and then over the past few years, it has been increasing by about 10% a year. Most likely, the net income is going to follow that. Let's check their balance sheet, make sure it's all good. Looks like they have total debt of 25 billion and net debt of 22 billion. Their book value per share is 11, so debt is most likely not really an issue for them. Cash flow. Let's check what they're doing with their cash. And it looks like for their buybacks, they did about $1 billion in buybacks last year, and they paid $4 billion in dividends, paying much more in dividends than they're buying back in stock. It's investors' preference. Sometimes buying back stock is better, sometimes dividends are better. But let's check their statistics out. And let's see their return on invested capital. Looks like it hovers around 20% on average, I would say, about 20%. Their net margin is about the same at about 20%. And their debt ratios, debt to equity, see, do they have a debt to EBITDA? Doesn't look like it. We can actually calculate that ourselves. Their EBITDA is 12 billion for the last 12 quarters. And they have net debt of 22 billion. So debt to EBITDA of about like 1.8. Not terrible, but also actually not great. Now, what I hate about pharmaceutical companies is this right here. I pulled this off of their presentation, and you can just see how many drugs that they are testing and how many drugs are in phase 2, phase 3, and it looks like one got approved out of however many last quarter. So it takes a long time for these drugs to get approved. We don't know which one's going to get approved, and we don't know, even if it gets approved, what types of revenue or earnings is that drug going to generate. All right, now let's look at a little bit more about Eli Lilly. So we've got revenue growth of 28% in Q4. That is a year-over-year number. So 28%, that is very, very good for revenue, and mainly driven by these 4 drugs. But I think they are overestimating this because it was actually mainly driven by this drug right here, just this one, Mounjaro. And we can see that here. Mounjaro, 27%. Okay, these 4 drugs right here, we can see the growth right there, and then the growth products as well have grown a little bit. Now, the reason I say it's Mounjaro is we can see here that the Q4 revenue for Mounjaro is 2.11 billion. If we look at this graph, it goes from 5 up to like 7.5. So 2.1 billion of that is just for Mounjaro. 2.1 out of the 2.5 billion of these new products is for Mounjaro. Now, the speculation here is that this Zepbound drug, which is supposed to help with weight loss, is going to skyrocket their revenue and earnings. So we actually can check the analyst estimates for Eli Lilly, and we can do that using Yahoo Finance. Zoom that in a little bit, and we can see the average estimate for earnings per share, 12.52, and then the year after that goes all the way up to 18.22. So that's almost a 50% increase. And then the revenue estimates, the average estimate is 41.5 billion for next year, and then the year after that is for 51.64 billion, or about a 25% increase. I put this all into a discounted cash flow model, so let's check that out. And I'll zoom in here. I put the EPS estimate right here. I put the revenue estimate in millions right here. They're doing almost pretty much zero in buybacks, maybe like 1 billion in buybacks. So we can do a billion in buybacks, and the net debt of 22 billion. At a discount rate of 10% and an exit multiple of 22, seems pretty good for a pharmaceutical company. 22 is okay there. And then our growth for the next year in her earnings is going to be 40%. Right after this 12.52 EPS, then it was 18. So we're going to say a 40% growth there. And then we're going to say that growth kind of tapers off after that, after some adoption of this new drug. And once it's adopted, then it becomes harder for it to grow. And we'll say that the growth going forward from there slows down quite considerably, down to about 5%. Then we can do the same thing with revenue. So these are two similar models. It doesn't matter which one you use. You could use both, like we are doing here. And for the discounted model with revenue, remember the revenue growth going into 2025 was about a 25% growth. And then after that, I did 20, 20, 17. So still high growth numbers for the revenue. And then it finally tapers off at the very end here. Now, profit margin, their profit margins back in the day or historically have been about 20%, but they are projecting their profit margins to be higher at 30%. And with this new weight loss drug having such high margins, I do believe that they're going to be able to hit these types of margins. So we have 30% going up to 35, and then 40 and 40, and then maybe we'll say that competition arrives in the space, or they're slowing down a little bit, and their profit margin declines as well, back down to about 25%, or their historical average. Putting all this number in, we can see that the fair share price, if we want a 10% return on our money, is around $480 a share, or if we're using this one, $440 a share. And with Eli Lilly currently trading at a price of $762 a share, I would not buy the stock for this price. Now, if we were expecting a lower return over the next 10 years or coming years, we could maybe expect like a 6% return. If we do a 6% return, it's still overpriced. Maybe if we do a 4% return, and even at a 4% return, it's still overpriced. And how about a 3% return? All right, so if you decided to buy Eli Lilly, assuming these growth estimates, you would be receiving a 3% return over the next 10 years. To me, it's not good enough, so I am going to be staying away from this name. But if you guys want to go for it, then just go for that. Like maybe you guys think the growth is going to be higher, but for me, I don't think it can sustain growth. All right, so that's it for me. If you guys have any questions or comments, make sure to leave them in the comments section. Otherwise, hit that like button and that subscribe button because I am doing lots of these analysis videos. And I'll see you in the next analysis.